Good afternoon, everyone. Welcome to today's Charity Village webinar. We will get started in just a moment. We just want to make sure that everyone has a chance to join us before we begin the session. We have people tuning in from across the country today, which is excellent. It's so nice to have all of you here. And with that, we will go ahead and get started. Welcome everyone to today's Charity Village webinar. My name is Mercedes, and I'm the Marketing and Communications Manager with Charity Village. As we are gathering here on a virtual platform, it is important to acknowledge that each of us is joining this webinar from the ancestral or unceded lands of the Inuit, Métis, and First Nation people. I'd like to acknowledge I'm speaking to you from the traditional, ancestral, and unceded territory of the Anishinaabe, which includes the Ojibwe of Fort William First Nation. Please join us in a moment of reflection as we recognize the Indigenous peoples as the stewards of this land. Let's acknowledge the mistakes and harm in our history and the ongoing injustice, and contemplate tangible actions each of us can take to move forward in a spirit of truth, reconciliation, and collaboration. For those who may be joining a Charity Village webinar for the first time, Charity Village is Canada's largest online job board for the nonprofit sector. In addition to our online job board, organizations can also post volunteer positions. So if you are looking for work or to recruit talent in the sector, Charity Village is a great place to start. We also have a ton of excellent resources for nonprofit professionals, including online courses, articles, fundraising tools, and free webinars like the one we are presenting today. Before we start today's webinar, I would like to quickly run through some housekeeping items. You may have noticed when you joined the webinar that you were automatically put on mute. Since we have hundreds of participants in today's session, it is important for us to minimize the amount of background noise so that everyone can clearly hear the presentation. But you can still ask questions and make comments using the question box at the bottom of the Zoom control panel. Look for that at the bottom of your screen. You can also email your questions to webinars@charityvillage.com. We will be taking questions at the end of the webinar, so please submit your questions as you think of them, and we will do our best to get to as many as possible. Given the volume of questions that we receive, we invite you to include your email address along with your question. That way, if we do not get to your question, the Ankle team will reach out to you directly. If you happen to encounter any technical issues with the webinar, please let us know in the question box or by sending us an email. We will do our best to get any technical difficulties resolved as quickly as possible, but in a worst case scenario, please remember that we are recording today's webinar and we will send you the full recording by email tomorrow. So if you get called away or disconnected, you will still be able to view the full presentation. Now I'd like to welcome one of our presenters for today, Omar Vizram, co-founder and head of growth at Ankle. Welcome.
Thank you, Mercedes. Really excited to be here and to kick things off today. First of all, just wanted to introduce myself for those of you who don't know me. My name is Omar, and I'm the co-founder and head of growth at Ankle. I'm a CPA CA, and prior to starting Ankle, I worked at KPMG for 8 years, working with small businesses and not-for-profit organizations. Today, I'm fortunate to work with many of our clients in the not-for-profit sector as they plan for change in their financial operations. Joining me today, I have 2 guests that I'm really excited to be working with. We have Jose Thibault. Jose is the practice lead for philanthropy and social innovation at the Discovery Group. Previously director of philanthropy at Mars Discovery District, she led initiatives in climate, health, and responsible technology. Her career spans youth employment, literacy, and higher education fundraising, with experience in both nonprofit and corporate sectors. Passionate about purpose-driven leadership and advancing social impact, Jose is based in Toronto. And next we have Navroz John Mohammed. Navroz is a leader at Manning Elliott, where he has built strong client relationships across the not-for-profit sector. He has a thoughtful and methodical approach. Over 2 decades, he has mentored young professionals, contributed to internal committees, and supported student recruitment. He is a CPA with a BBA from Simon Fraser University. Navroz combines technical expertise with a personable style that makes him a trusted advisor, and Navroz is based here in Vancouver. Now I'll just tell you a little bit about Ankle before moving forward. So as I mentioned, I'm the co-founder of Ankle. I started Ankle in 2016 really with a simple problem in mind. And that problem is that you can't build a great organization without good books. This continues to drive all of the work that we do with our clients. Today, we have 300 clients across Canada. We work with over 100 not-for-profit organizations across the country. We have really two areas of specialty. One is financial operations support, so that's bookkeeping, payroll, all of the process-related activities in finance that keep the organization moving forward. We also offer financial management support, which includes CFO advisory and controllership services. Today, I'll spend a little bit of time talking about those services as we go through. I also want to acknowledge that Ankle's offices are located on the traditional and unceded territories of the Musqueam, Squamish, and Tsleil-Waututh nations. We're grateful to live and work on these lands and recognize our responsibility to learn from and respect Indigenous communities whose stewardship continues today. At Ankle, we're committed to ongoing reflection and learning as part of our journey toward reconciliation. Oops. Sorry about that, going the wrong direction. All right, in terms of an overview for today, we will be covering why financial oversight matters to nonprofits. We will discuss board versus management responsibilities in not-for-profit organizations and leadership. We will talk about practical tools. We will cover concepts such as the RACI matrix, policies and simple controls that you can implement in your organization. We will have a section called Governance in Action, where we will talk about fractional controllers and CFOs, and specifically the impact that they can have on your organization. We will cover best practices in approvals, reporting, and board collaboration. And finally, we will talk resources. We have some special resources to share with you, tools, and we will go into a Q&A session. So why all of this matters? I think it's important to think about why we're here and what we're really trying to achieve. These are some of the themes that we see when working with not-for-profit organizations. So one, many boards avoid financial discussions or ultimately receive reports and information that is too late to be useful. Treasurers are often unsure what to review, and there are oversight gaps. Executive directors are left isolated and often carry the financial risk. Strong oversight ultimately empowers decision-making and strengthens mission impact. As we were starting to plan for this webinar, Navroz, Jose, and I had a few chats about what would be most important and meaningful for you. Jose actually shared this with us, and we all thought that this was so incredibly relevant to what we're covering today. So I'm actually going to ask Jose to come online here and give us a little bit of context on how this case relates to what we're talking about today and why it matters.
It's I mean, we don't know the inside story, but yeah, it was I think originally brought to the courts in 2018, but the leader of this organization has been found guilty for the second time of fraud. We don't know the inside story, but just knowing the outcomes, you can't help but feel your stomach kind of churn a little bit. It's about money. It's about financial mismanagement. It's about an organization being deprived of their own funding for personal gain. But I think even more than that, it's about a breach of trust, with staff, with board, with government stakeholders, with donors, with the public. And it's exactly the kind of situation we want to avoid as leaders and as board members.
Thank you for that, Jose. All right, poll time. So please respond to this question. You will see a pop-up on your screen. On a scale of 1 to 5, how confident are you in your board's financial oversight? 1 being high risk, 5 being crystal clear confidence. All right, just bear with me for one moment here.
While you're doing that, Omar, I can read out the results of poll
Sure,
one.
that would be great. Thank you.
Perfect. So we had 5% of people note that they are 1, so high risk and confusion. 12% noted number 2, 31% noted 3, 40% noted 4, and 11% noted 5, which was crystal clear confidence.
Great. Thank you for that, Mercedes. All right, let's talk board versus management responsibilities in financial oversight. Navros?
Perfect. Thanks, Omar. Excited to be here today. So, as a reminder, the board of directors represents the membership of the organization and is responsible and accountable to all of the NPO stakeholders. So, when we think about the NPO stakeholders, these are the beneficiaries, donors, volunteers, the government, the community at large, and also other NPOs. The board also has fiduciary duties. So, they have a duty of care, a duty of loyalty, and a duty of obedience. This all means the board has to act in the best interest of the organization and avoid any personal conflicts, while also ensuring the organization stays true to its stated purpose. So the main responsibility of the board is really setting the strategic direction. It's there to establish and uphold the organization's mission, vision, and goals. And it's there to lead the strategic planning process to determine the long-term goals and how to achieve them. So let's start to summarize the main responsibilities of the board and how this interplays with the role of management. In NPO financial oversight, the board of directors and the management team have distinct but complementary roles. The board is there for governance, while management is there for execution. If we want to look at it very simplistically, the board makes the choices and management carries them out. So the board is responsible for the health of the organization by establishing policies and reviewing results, while management handles the finances, such as the bookkeeping, accounting, and financial reporting. The board also approves various budgets to ensure alignment with the mission, vision, and goals, while the management is there to work with boards to create and implement the budgets and spending plans. The board also makes major financial choices, including spending on large expenditures or investments, whereas management's there to identify these areas and work with the board to make recommendations. So the best organizations that we see really have a strong management team in place where the accounting functions and reporting are fully kept up to date. This allows the board to receive timely financial information to make conclusions and also determine where expenditures are aligning with budget and if other key spending cuts or initiatives are required. The board is also there to ensure that management has implemented effective processes to protect against financial and cybersecurity threats, while management's there to identify, assess, and mitigate these risks by implementing internal controls to protect the assets and prevent fraud and error. So as an auditor, this is something that we see is very commonly overlooked. Internal fraud, as we saw in the example earlier, can always be an issue when there is a lack of segregation of duties and oversight. However, there's more external risk through phishing, ransomware, and even data breaches. I'm sure you've all heard stories out there where an NPO has unfortunately been scammed out of thousands of dollars. A recent trend that we're seeing is the fake donor scam. This is where a donor, they may donate and send a check in for, say, $100,000. Everything appears legitimate. However, the donor then comes back and asks for a certain amount back as they indicated that they accidentally over-donated. So many NPOs, out of the goodness of their heart, will say, okay, here's some of the funds back, and they'll use their own dollars to pay it back before realizing the deposited check bounced. Obviously, this is quite tragic. So it's just another example of the scrutiny that NPOs are under, and really there should be proper training and sufficient controls in place to prevent such fraud from occurring. The board's also there to ensure the organization adheres to applicable laws and requirements such as CRA filings, while management's there to actually prepare these filings and reporting requirements. This is another area that we don't see enough emphasis on. If an organization does not keep up with its filings, say it's the Registered Charity Information Return, GST returns, or other filings, it can actually risk losing its charitable status. So it's really ultimately up to the board. If it feels that the board or management does not have the expertise to complete these filings, they need to reach out to experts in the field and identify these areas early on. I recently read a report that in 2024, over 2,000 registered charities lost their registered charity status. The main reason was for delinquent filings. There were also instances of losing charitable status because the organization was not operating within its stated purpose. In my time at Manning Elliott, I've also seen organizations get in trouble because of donation receipting. A large benefit of being a registered charity is that it's able to issue donation receipts, but there are very strict rules in place on how these receipts must be issued. And a lot of organizations are not following these rules and are also getting in trouble with the Charities Directorate. The board's also there to review reports, including statements of operations, financial position, and cash flow, while management's there to prepare these internal and external financial reports for the board, donors, and the regulatory bodies. So all too often as auditors, we don't see enough of this oversight happening. Many times when the audit begins, the financial information hasn't been thoroughly reviewed, there's incorrect information, numerous adjustments are required, and this delays the whole financial reporting process. So if the information we receive as auditors is incorrect, it really brings into question the oversight of the board and also the work of management and any related finance or audit committees. So the key takeaway here is the board establishes the financial framework and provides oversight, both of which are critical for the success of any organization, while management's there for the daily execution and implementation within that framework. Overall, it's best practice not to have crossover between board and management roles so that all the responsibilities and accountabilities are clearly defined and executed. The board is there to oversee and guide the management team, acting as a liaison between them and external organizations. You have to remember, at the end of the day, the board is ultimately responsible for the actions of management. So let's move into some practical tools and best practices. Omar mentioned this in the introduction. So a good project management tool that many organizations use to clarify roles and responsibilities is the RACI matrix. I'm not sure how many of you out there are using it, but I'll go over what the acronym RACI means. So we have R, and it's for the responsible. So these are the individuals completing the task, most likely management. A is for accountable, most likely individuals approving and owning the task, so that would be the board. C is for consulted, the individuals providing input, and depending on the task, this could be the treasurer, the ED, or the board. And I is for informed. These are the individuals getting an update on the progress. So these could be the members or various stakeholders. So what are the benefits of using this matrix? So firstly, it improves clarity and prevents confusion. It ensures everyone understands their specific role and how it contributes to the organization's objectives. It enhances accountability. Each task has a designated person, ensuring someone is ultimately responsible for its success and completion. It also streamlines communication. So it provides a framework for who needs to be involved in discussions and who just needs to be informed. It optimizes resources. So it ensures that staff and volunteer hours are focused on most crucial tasks and that everyone's time is used efficiently. It supports decision-making. So with clear roles and accountable party for each task, it prevents projects from stalling. And then lastly, it facilitates onboarding. So with new volunteers or staff members coming on board, they can quickly understand their specific responsibilities and make their integration into the organization much more smoother. So I think a couple slides over, we have an example here of a racing matrix. So this one here, the example here is a charity gala event, but really it can be used of anything of importance. So we can see we have the various tasks on the left-hand side, and then the various parties on the top, including management and the board of directors. Not going to go into huge detail here. And again, this is just an example out there, but it can be used for any task. But it really helps define the roles and responsibilities. So it's really a tool that we recommend lots of not-for-profits use. And it can be used in various functions from the lowest of tasks to the most important tasks. So next, let's get into policies. So policies are very important when it comes to governance, and we'll talk about that later in the presentation. But the way to achieve great governance is through strong policies. So these policies need to be clear. They need to be aligned with the organization's mission and cover all areas, including procurement and spending, conflict of interest, fundraising, and record keeping. These policies then ensure financial integrity, which helps foster accountability and public trust. So if we want to focus on financial oversight, the key is policies around procurement. So to prevent fraud and error, no single person should have complete control over a financial transaction. A good policy should be broken out separately and have a requester, an approver, a purchaser, and a payer. This helps eliminate the chance of fraud. Spending limits can depend on the size of the organization, but an example will be to establish a hierarchy for purchase approvals. So for instance, if we have minor purchases, say less than $500, this can be approved by a manager or department head. If we had mid-range purchases between $500 and say $10,000, this could be approved by the senior management or the finance team. And then if we get to larger expenditures, say over $10,000, this would have to be approved by the board and the executive director. So what we've seen is many organizations lack sufficient policies. Therefore, an option there is to conduct a policy gap audit. So a policy gap audit helps identify deficiencies against established best practices or required standards. They can cover various areas, but when it comes to financial information, it should center around procurement and approvals. So when we're looking at financial oversight, it can look at things such as financial reporting and budgeting, internal controls, risk management and insurance, investment policies, and also fundraising and donations. You can also dive deeper past financial policies and look into other areas. This will be foundational governance, so things like your mission, vision, and values, the bylaws and constitution, various roles and responsibilities, the board composition and recruitment, and also board and management evaluation. And lastly, you can also look at operational and human resources. So this would be things like recruitment, retention and training, volunteer management, communications, independence, and whistleblower protection. Depending on the size of the organization, this is something that we recommend takes place every couple of years, just to close the gaps and ensure an organization has the right policies in place. So I'm going to turn it back to Omar now. I think he's got another interactive poll to go through.
Thank you, Navroz. All right, let's get to it. How frequently does your board review financial statements? Monthly, quarterly, semi-annually, annually, never, or more often? Let's see what you have to say. All right, we have some results here. So 38% are saying monthly, 48% are saying quarterly, 5% are saying semi-annually, 7% are saying annually, 1% are saying never, 1% are saying more often. I would say that these somewhat meet my expectation, I guess would be the comment. But thank you for those details, everyone. Let's move on. All right, let's talk about strengthening financial leadership. Ultimately, in order to deliver on a lot of the infrastructure that we're talking about today in terms of controls, policy, reviewing numbers, you need to make sure that you have the right team in place to make it happen. So why controllers and CFOs matter for boards? Ultimately, they bridge the numbers and strategy. They turn financial data into insights that boards can act on. They also create that important line of distinction between who's responsible for preparing the numbers and who's responsible for reviewing those numbers and guiding the strategy. They strengthen oversight, support fiduciary duties with deeper financial review and risk management. They prevent blind spots. They will help to flag risks, compliance issues, cash flow concerns early. They enable better decisions, so providing forecasts and scenarios to the board to align resources with the mission. And ultimately, they free up leadership. They lighten the load on the executive director. They make sure that treasurers are not deep into the numbers so that they can focus on governance. I often get asked the question of what do controllers do? What do CFOs do? So I thought I would provide a little bit of an overview. Controllers are typically involved in reviewing what has happened in the past, helping the organization understand what those numbers mean and perhaps how numbers and details may impact the future. They will help with implementing and monitoring financial controls, preparing monthly or quarterly board packages, also debriefing the financial results. This is a really important one. So helping non-financial people understand the numbers in terms that they can understand. They support the year-end accounting process, so getting you through the year-end audit or review. They will also help to calculate and monitor debt covenants, and they will help with ongoing expense management and review, and also related controls around expenses. What do CFOs do? CFOs tend to be more strategically focused and focused on future activities. So cash flow forecasting, strategic decisions around expansion opportunities or expense reduction. Now, the execution of a lot of this will happen through the controller. Financial projections and forecasting, grant applications. Again, grant applications are often done by controllers as well. Financial strategy and board reporting, and reporting on financial controls and areas of risk to management and the board. Now, just to sort of summarize those two slides, you won't always need a controller and a CFO. To some extent, it depends on where you are in your journey as an organization. We have many clients that have both. We have many clients just have one or the other. So it really is sort of context specific. But why go fractional? Fractional controllership and CFO is a service line that we offer here at Ankle. And in general, we're seeing a lot of our clients go fractional in a variety of services. HR is another really popular one. But ultimately, going fractional allows you to get the leadership, in this case, financial leadership, at a fraction of the cost of a full-time hire. So it becomes a lot more accessible to organizations of all sizes. And the way I like to explain it is you get 80% of the results with really 20% of the time. The reason I say 80% is because the person may not be in your organization, in your office all day, every day, but they can achieve a lot with just a little bit of time. It is a flexible and scalable model, so services can be scaled up to match your organization's changing needs or down if needed. And also, going fractional allows you to receive a broader base of experience, so you can find the right person to solve the right problem. People with diverse industry backgrounds can come in to help you solve problems that the organization may have at that specific time. All right, over to Jose to talk about some best practices and getting into the nitty-gritty around approvals, reporting, and board collaboration.
Thank you, Omar. When it comes to financial management in a nonprofit organization and the relationship between board and leadership, my rule of thumb is no surprises. So, and that really, I mean, much like Navroz was saying, that starts with strong governance foundation. Operational predictability is really grounded. It relies on appropriate and relevant policies and making sure that everyone follows processes that are transparent, that are accessible, that are documented. So you want to think about policies on big issues like your investment measures against fraud. Navroz has reminded me we need a ransom policy, a conflict of interest, your relationship with donors, fundraising, compliance. But then how does all of that filter into the internal controls that ensure clear, clean, and consistent decisions? So your organization needs clarity on day-to-day things like who oversees the ED's expenses? What are the spending limits? What contracts can be signed? Who can sign them? What gifts will you accept? Are there salary caps? Who approves them? Who owns program budgets? All of these considerations are meant to protect the board, leadership, and really your whole team, and you need to have those really well articulated. The second part of that foundation is your strategic plan. Your strategic plan drives the budget, and big decisions should really fall directly from that. Your budget is prepared by the management team. The treasurer reviews and ensures that it is realistic, that it is achievable, comprehensive, and that it is aligned to your strategy and your organizational objectives. Third, in that foundation piece, and in our work at the Discovery Group, we see this happen and we encourage organizations to have a risk register and really to keep it to the top 3 or 4 issues that the board need to be mindful of. So sometimes you'll see risk register that's about 20 items long, and it's true they're all important, but it can be a little bit overwhelming and can sort of diffuse attention. So we recommend 3 or 4 issues that the board really needs to think about. We recommend that they not all be reputational. Think about those financially driven risks or risks that have financial consequences and talk about those. Then, with a strong foundation, your reporting should be clear and it should bring people along. So that includes, your income statements, your balance sheets, your cash flow statements, actuals to budgets. They should be professional. They should be consistently error-free. You can include additional reporting that is important to the health of the organization. That could be funder or program specific. It really depends on your organization and what you feel is important. It's okay to have visuals and graphs to better illustrate the story that the numbers tell. I find that particularly useful if you have a board that is less familiar or not as comfortable with financial oversight. That can help. The goal really is for everyone, leadership, board, treasurer, to feel that they are on the same page, that they understand the same information in the same way. And when you have a solid foundation and strong reporting, you can turn to running your meetings efficiently. So on the next slide, you'll see that financial oversight should really feel like a safety valve, not a big brother situation. Your goal is to help the board see around corners. Your goal is to help leadership make good decisions. Your goal is for leadership and the board to be confident, again, that they understand the same information. So I'm repeating myself, but there should be no surprises, especially for the treasurer. The treasurer should have time to confirm that the information that leadership is providing is clear and sufficient. I'm a fan of having a meeting before the meeting. You may have a finance committee. You may call it really clever things like the Finance and Audit Review Committee, or FARC. They would meet before the board meeting to review reports and to address any issues. If you don't have those structures, we encourage leadership to at least meet with the treasurer in advance of the board meeting. This makes leadership better prepared. It gives the board confidence too that they don't need to be poking around in really small details, that they can focus on the more important issues and on the bigger picture because the treasurer has had a chance to do their own job. As a CEO or as an ED, if you need to secure any approvals or if you have significant budget changes, that should be really clear in your agenda, which of course is provided well in advance so that everyone is ready to talk about it. Save time, please, in your agenda to review the risk register. And then, of course, make sure that your financial reports, all of them, are shared in advance so that everyone has a chance to digest the information. Now, acknowledging that that can be tricky if you need to meet with your treasurer and set the agenda and then send your reports all in sequence and all in advance of the meeting. It requires some advanced planning, but it's really about maximizing time and ensuring clarity. Once you're in your meeting, you review the report, you review your budget, as it aligns to your strategic or operational plan. We said we would do this, we've allocated this amount of money to do it, this is how it's going. Give the board time to ask questions if they have any before approval. So you provide the big picture, but the board should be able to ask for clarification on things when they need it. So you should have details in your back pocket as an executive director or CEO or as a treasurer. Special note too, lots of organizations increasingly run a consent agenda, which is great. But then you really need to invest time. I would recommend in those those foundational pieces. So your policies, your procedures should be really clear. Your relationship with your treasurer should be strong, and you should have some strong, capable internal financial management. Again, no secrets and no surprises. In terms of roles, your ED, CEO, leadership, as mentioned, they should have the autonomy to steer the ship operationally to ensure that finances are aligned to the strategic plan, that they can operate on the daily, that they have the capability to do that, and that they can see around corners as much as one reasonably can. So preparing financial reports, managing budget, managing the audit process, those are internal responsibilities. Your treasurer safeguards the organization's financial health. They liaise with the board in terms of financial oversight, and I really see them as lending bi-directional assurance, right? This way that leadership is realistic and transparent and capable, that they can maintain financial discipline, but they also provide an assurance the other way, that the board understands their role, that they're paying attention, and that they're committed to guiding the organization strategically. Your treasurer also has the overview of investment portfolios and, of course, compliance with laws, regulations, and internal policy. A note on the treasurer and ED relationship. They are absolutely a trusted advisor, but it's not about day-to-day management or operational advice. That person is not your treasurer. If you bring them in at the management level, you're confusing responsibilities and you can create challenges of governance. The treasurer needs to be able to rely on the management team for efficient execution, for preparation of reporting, so that they can do their own job well. Leadership needs to have that internal bench strength. So I'm thinking a little bit around what Omar was saying earlier around controllers and CFOs and fractional resources. Distinctions and clear lines, and I've worked in really small organizations, with budgets under 500,000. Those clear lines, they really only work when everyone feels really confident and capable, and it's not reasonable to expect to know everything. But it's important to remember that you can and should bring in help whenever you're experiencing or dealing with something that's above your comfort level. The board vis-a-vis financial oversight is really the safety valve. Again, they're connected with the overall direction, the strategy, the mission of the organization. They keep a clear eye on that overall direction. And we suggest, in terms of financial oversight between the ED or the CEO and the board chair relationship, at Discovery Group, when we work with our clients, we suggest that it is that relationship, it is those two that set risk tolerance and what the risk register looks like, both for the budget and for investment. They're foundational pieces. Those are really existential to the organization, how you invest, what you invest in, when to hold the line, when to take a chance. Those things have significant impact or can have significant impact on the success of your mission. And they should really be discussed in that context. So in that context, so we suggest that's a board chair and CEO conversation. Your treasurer, your CFO, of course, have expertise and can inform that discussion, and then they'll be relied on to ensure that everything moves in keeping with agreed upon risk tolerance. In terms of fiduciary responsibility, then, suggesting that everyone has a role to play on key items for budget, leadership builds, treasurer confirms, board ensures that it's aligned to strategy. For reporting, leadership prepares, treasurer confirms, board keeps their eyes wide open. And in terms of risk tolerance, the ED and the chair set the comfort level. Treasurer provides good counsel, and the board engages on a regular basis. And then a final note, on the next slide, this stuff really matters. Regardless of the size of your organization or your budget, really good governance from the get-go. It ensures good outputs like useful reports, clear procedures, effective committee work. It facilitates effective oversight. Good governance builds trust internally, but also with funders, with stakeholders, and with the general public. And good governance is really the foundation to prepare an organization for growth and for strategic opportunities. It helps you weather inevitable storms, especially in this day and age, and bonus, if with a little bit of luck, it keeps you out of the papers.
Thank you so much for that, Jose. Just some final thoughts before we get to the Q&A. Oops, sorry, I'm struggling today with the basics of scrolling here. So just to conclude, I want to leave you with this thought. Really, strong boards use financial insight, not just to review performance, but very importantly, to guide strategy and set the direction for the organization. That kind of leadership is built on a few essentials that we talked about today. So clear reporting, I think we heard that. I think all three of us actually talked about that. Clear reporting that gives everyone the same view of the numbers, sound policies that create accountability, and very importantly, well-defined roles that keep governance strong. But even with those foundations, it really takes the right expertise to turn information into action. At Ankle, our role is to bring that clarity and discipline to your financial operations so leadership teams and boards can move forward with confidence. With the right insights in hands, you're better equipped to drive sustainable growth and ultimately to achieve your mission. Thank you so much for being part of this session today. We hope you're leaving with some really practical ideas on how financial clarity can strengthen your organization and the relationship between management and the board. So just before we jump into the Q&A, I wanted to let you know that we will be making this available to you, this guide. This guide is relevant to what we talked about today. And it's quite comprehensive, so I'd suggest that you download it, refer to it, and we wish you all the best. Now let's jump into Q&A.
Great. So for the first question, how would you suggest encouraging boards and management to implement this level of governance discipline when they may be reluctant to put the time and effort in?
Do you want me to take that?
Yeah, why don't you take that one?
Well, I think it's just really important. Anytime anyone joins a board, we talked about the fiduciary duties that they have to put in the time. Like it's not just a role that you play, say, I want to help this not-for-profit and join the board and provide my expertise. There are instances where board members can get sued if they don't have the proper governance in place. So, I think it's also, you want to embed some of these within your bylaws and your constitution, set the policies out when you're recruiting board members that these are the expectations to follow and having the right board members in place. So obviously it's, we're dealing with a lot of people who are volunteering, so time is very limited. So you want to be upfront with the commitment and ensure that these individuals are spending the appropriate amount of time. And really, it just helps the organization stay on track, avoid issues with the CRA or charities regulations, and also then just making sure that there's proper financial reporting, because all this gets scrutinized, publicly. You don't want to be on the news and be found to be mismanaging donations or government grants.
Exactly. Thank you. So for the second question, in regards to approval, how should supervisors and managers approve their own expenses? For example, should another manager approve their expenses?
I'd say yes, but Omar, go ahead.
No, I was gonna say yes. The answer is yes. And I mean, you want to map out your org chart and the approval matrix. I think that's an important one. And ultimately, things should be getting approved by one's supervisor. What we've often seen is the executive director's expenses get approved by the treasurer. Um, Navroz, Jose, I don't know if you've seen anything else or you have any other practical tips there, but that would be my general advice.
Agreed. Yeah. And I mean, it really depends on the organization and what types of expenses that you're having. You may
Yeah.
have, certain types of expenses or certain amount cap where you choose to escalate to someone else. But clarity and consistency are the key pieces
Mhm.
there.
Great, thank you. So this next question is a two-part question. So what frequency do you recommend that nonprofits review financials and reporting with the board? And for the second part, if there's resistance, do you have any recommendations to drive change?
So this is a good question. And when I put that polling question together, I thought there really is no right answer between monthly and quarterly. That's my view. It really depends on where the organization is, the level of financial sophistication, if it's needed. I would say at a minimum quarterly. Boards should be reviewing financial statements at least quarterly, would be my comment there. If there is resistance, I draw on what Jose said earlier, and I think that putting things together visually, it's often the case that people just don't understand. And there are some really fantastic tools that we use at Ankle to help our clients understand their numbers better. It's probably taking it out of the typical, QuickBooks financial statements, putting some very clear visualizations, some KPIs together. Don't be afraid to use color. That helps too. But I think that visuals really help.
Thank you. And for the next question, do you agree that multi-year analyses and reports are helpful in identifying trends and informing planning and decision-making?
I have mixed feelings on this, to be honest. And Navroz, I'm interested in your thoughts on this. I think you need to do multi-year planning and analysis, but the environment changes so quickly, right? Like we've seen massive transformation in the US, I think faster than anybody really expected. And that is going to have impacts on all of us. And so I think it's important to have as sort of a guide as part of your strategic analysis that you do. But I also am cognizant of the fact that I don't think organizations should spend an excessive amount of time on multi-year planning because, it's going to change, right? So a bit of a mixed answer there. Navroz, do you have any comments?
Yeah, I agree with what you said there. I think there was some value to looking at the data and information, but as you said, I think it's more important to be adaptive, right? Things are happening, things are changing. We see funding levels in our government going down, donations are going down. So it's really how is the strategy going to adapt the changing environment?
Yeah.
Thank you for sharing those insights. So for the next question, will you please discuss the role of the Finance Committee? In this instance, it's comprised of board members and others as a subset of the board.
Navroz, this is all you.
Yeah. So what we've usually seen is, the finance committee there is responsible for reviewing the financial statements in detail and the financial information. So it's really a great tool in place. It depends on the size of the organization. If you can have a finance or an audit committee below the board, and that committee then is comprised of people who have all that financial knowledge. So the key there is, it'll be comprised of some board members, but also some independent individuals as well from the board. And what can happen there is it allows the board to free up some of its time to work on the long-term strategies and work on the other goals that we talked about within our presentation, and allow the finance committee to focus more on the financials and then provide the key information that the board needs to make those decisions.
Thank you. This question ties into that one as well. So we received a few questions surrounding this. Will you please confirm if the treasurer is a board member?
Usually, yes, we've seen the treasurer is a board member, correct?
Okay, thank you. And then for smaller nonprofits, controllers and CFOs are not always feasible. At what stage of an organization's growth should this be crucial? And is there some flexibility for smaller organizations?
Yeah, so just back to the concept of fractional, it does actually allow, like we now have clients below that $500,000 a year annual operating budget level that have fractional controllership and CFO services with us on a very limited basis. So it is achievable. I think it's more accessible today. There is no magic number is the reality, and I really don't like to leave you hanging with that, but there is no magic number, I would say.
Okay, thank you. And for the next question, how does your board model influence financial management? We follow a Carver model of board management.
Yeah, I can say that. Yeah, I think it definitely has a big influence. So if you follow the Carver model there, that's a great tool to be using. There's definitely lots of models and tools out there to be implemented. So, I think for any organization, it's good to have something in place. The key is to start somewhere. And so if you have that going for you, that's where you can, start to see change within the board and within the strategies.
Perfect, thank you. And what do you advise as best practices for smaller organizations that can't have full segregation of duties? For example, bookkeeper also generates reports in this instance.
Yeah, I think that's just where it comes more to having that oversight. There's a lot of small not-for-profit organizations out there that just don't have the resources, and we're seeing an individual complete the tasks of maybe two or three other people. So this is where the ED has to get a little bit more involved. If you have a finance or audit committee or the board to get involved to making sure that there is proper controls in place and having proper oversight. Even doing some spot checks of the work that's being done needs to be taking place. At the end of the day, as I mentioned earlier, the board is there to be responsible for management. So we can't just say, okay, well, we're a small organization, we can't do anything about it. There has to be a plan in place to make things work.
Thank you. Okay, and then the next question, please share best practices for nonprofits and charities to prepare for an audit.
I think maybe Omar can talk about this a little bit as we've worked together on some mutual clients together. But I think, it's just, maybe you can talk about it at your end a little bit, but for us as auditors, we want the information to be fulsome, right? When it comes to us, the whole goal is not to have any, audit adjustments, right? That's the goal of all parties, and to make things clean, to have the proper timeline set in place. And so, the accurate record keeping is, fundamental to that, so that when the records come through, there's still the whole process to go through and do the audit. But this is where we want to focus on the risk areas. Has management and the board or the audit and finance committee reviewed all the information before it comes to the auditors? And so that when we're doing our work, we're just kind of dealing with the high level issues and making sure that we can get things ready for the board review and the subsequent AGMs that take place.
What I would suggest, and this is on the internal side, of course, because at Ankle we're involved before the auditors get involved, and we help to facilitate the process of going through the year-end audit. We really believe in monthly financial statements. I know that's not always feasible, but we treat every month as like a sort of year-end. We always say your books should be, pretty well year-end ready every month. But on top of that, it's important to do sort of a year-end close, right? Like really look at the books critically, do a little bit of internal review. And that's where, your finance person, whether it's bookkeeper, controller, they're taking a really close look at the numbers before they go off to the auditors. We really like to see that by the end of the first month after year end, the books are ready to go to the auditors, but that they're not changing. The numbers are not changing once they go to the auditors. They are final numbers that are being handed off. The other thing is just making sure that you have support for all of the important accounts. You probably know, if you've had an audit before, what the auditors are going to want to see. Deferred revenue, make sure you have that on a schedule tying to what's in your financial statements. So I would say it's good hygiene throughout the year, and then really that review before the numbers go to the auditor and make sure those are final numbers.
Thank you. And then this question also ties into that. So how important is the internal audit function to ensure risk and compliance?
Yeah, I can speak to that. I think, yeah, I think it's very important. It depends on the resources, again, that an organization has. If you can, have the time to have an internal audit function to go through that process, again, it just, provides more evidence internally that things are going well. And then also for the auditor, as as Omar alluded to in the previous answer, that the information coming to the auditor is all ready to go and there's no adjustments and all the controls are properly in place.
Perfect. Well, thank you very much for presenting such an informative webinar today. Do you happen to have any final comments before we sign off?
Thank you, Mercedes. I just really want to thank everybody for their time and remind them that we will be sharing certain resources that can really help you as you think about some of these concepts that we discussed today. I really also want to thank my co-panelists today. So Jose and the Discovery Group. The Discovery Group is a phenomenal partner of ours. We're so pleased that Jose was able to take the time and join us today and lend her her very broad expertise to this webinar. And then Navroz and Manning Elliott, a very important firm for us. We have a lot of common clients with Manning Elliott. They do great work in the not-for-profit sector. So huge thank you to you, Navroz. And of course, to our partners at Charity Village. Thank you for providing us with this platform. And thank you to all that attended. Have a great day.
Wonderful. Thank you very much for presenting today. I just wanted to remind everyone that you will receive a follow-up email tomorrow with a link to the webinar recording. Please feel free to share this link with your colleagues. The email will also include a survey link that you can fill out with your feedback on today's webinar. You should see a survey link pop up right here in Zoom following the session as well. On behalf of Charity Village, thank you so much for joining us today. I hope you'll join us for our next free webinar, Compensation in the Nonprofit Sector. You can find more information on this and all of our upcoming webinars at charityvillage.com/webinars. Thanks again for joining us. I hope that you enjoy the rest of your day.